All right, everyone, we're going to get started. So first off, I'd like to thank our sponsor, Stradling, for sponsoring the Lunch and Learn series and for their overall support of UCI Applied Innovation. Today's speakers are Kirsten Leute and John Lee. Kirsten and John work for Osage University Partners, which is a venture capital fund that invests exclusively in startups that are commercializing university research. Kirsten is a senior vice president of university relations. Previously, she worked at Stanford University's Office of Technology Licensing, where she became experienced in high technology inventions as well as software, trademark, and copyright licensing. Additionally, Kirsten serves as vice president of membership development in the Western Hemisphere for the Association of University Technology Managers. She holds a BS in biology from Wellesley College and an MBA from Santa Clara University, and is also a registered U.S. patent agent. John is a principal at Osage, where he focuses on infrastructure support, enterprise software, and hardware. Previously, John spent time at Lux Capital and was a manager in investments for Mahindra & Mahindra, where he worked on diversified investments in in-house startups in technology. He holds a BS from Cornell University. They are here today to speak about venture capital and Founders Equity 101. Welcome, Kirsten and John.
Thank you. So thank you so much for having us here today. We're really pleased and honored that we are here to talk with you about venture capital and founders equity associated with university startups. We can actually skip our first two slides, so thank you. Already we're on slide number 4 because we didn't have to introduce ourselves. We're going to give you an overview of our fund, just because it'll give you an idea of the perspective that we're bringing to both of these topics. We are a venture capital fund that invests in startups out of universities. We currently are on our second fund. We have a total of $315 million of assets under management. We invest in startup companies out of universities that we partner with. We're currently partnered, actually, with, this number's wrong, with 97 different academic institutions, mainly in the United States, but also in Canada, Israel, and Singapore. One of the benefits that our universities have with working with us is, one is we like to come on campus. We like to talk to researchers. One of the benefits, obviously, is giving these kinds of talks, but also for us, it's really getting to know who it is that's starting the companies at the institutions, looking for those investment opportunities, and providing advice and feedback since we have so much experience in the university startup network. Just as a quick show of hands here, how many of you are researchers here at the institution? Okay, how many of you have done a startup company before? Generally, everyone. Okay, how many of you are new to startup companies? You haven't done a startup company before. Okay, and I'm sure I missed other people in the audience what your backgrounds are, but that gives us a good context for the conversation we're going to have. So as I mentioned, we have 2 venture funds so far. We had a fund 1. We had $100 million of capital under that. We made 39 investments out of that. We're currently investing out of our second fund, and we've made 47, is it 47 still, investments out of that? Yeah. We have a few more investments to make out of that particular fund. We're currently fundraising now for our third fund, where we're targeting about $250 million. So just to give you an idea of our fund itself. We invest in basically all areas. We mirror academic institutions. You invent in all areas, we invest in all areas. And we actually have an investment team divided up into what we call tech, or physical sciences, and life sciences. And so we have experts. Most of our investment team has some kind of advanced degree in the scientific discipline that they're investing in. And we invest in a lot of different areas under the tech and kind of life sciences portfolios. But we look at things that are kind of outside even those realms. We've looked at things in agriculture, in food maintenance. What are some of the other kind of out there things?
We've looked at exoskeletons.
Right. It's kind of all over the place. And it's really fun. I mean, one of the things that's really rewarding about working with the institutions is we get to see all these next generation, really honestly, next generation technologies, and get to examine kind of where the fields are going. So just to give you an idea that we invest in all areas, we also invest in all stages. So we see opportunities at all stages, from a seed stage opportunity all the way to pre-IPO. We obviously, if you look at this slide, you can see that we kind of have a sweet spot of investing around the Series A, but we really are looking at opportunities at all stages out of the academic institutions that we work with. And if you would like a copy of these slides, just come up to us at the end. We're happy to send them to you. And I believe that UCI can provide them as well. Our investment strategy is actually to co-invest with other top-tier investors. We typically do not lead the rounds ourselves. Making so many investments with the amount of capital that we have, we typically aren't going to be the lead investor. We typically aren't going to be taking the board seats on the companies themselves. So we're typically investing along with other investors. One of the things that we do as one of the benefits for our institutions is when we see promising opportunities, if they don't have a lead investor, we go out and make introductions to other investors and try to help them find potential investors. I'm going to skip the next two slides and just talk about the opportunity. For some reason it's not skipping. Okay. One of the reasons that we're so interested in what we do is that the universities are just so ripe in creating startup companies. So this is actually a figure from Autumn, the Association of University Technology Managers, about how many startup companies are coming out of universities each year. And this is just US universities. But you can see in 2015, it was just over 1,000 opportunities. I know in 2016 it was also over 1,000 new startup companies coming from universities. And so there are a lot of opportunities out there in this space. And that's why we in particular are interested in university startups. So the first part of our talk is going to be talking about venture firms and how they actually work. Because if you are a startup company and you are considering taking capital from venture capital firms, you need to understand about how venture capital firms operate and why it is that they ask for what it is when they actually invest in you. So basic organization of venture funds. The venture funds consist of general partners who are the venture capitalists associated with the funds. These are the people doing the day-to-day management of the venture capital funds, of the potential investments and the funds that are associated with those. And then you have the limited partners on the other end. The limited partners are the investors. They're the people who are committing the capital to the venture capital fund. The limited partners in a venture capital fund are typically endowments, pension plans, high net worth individuals, family offices. Some companies have their own investments that they like to make in venture capital funds. And so typically, the general partners then go out and they raise these funds, and this is what we're doing right now, is we're going out and raising a fund from these limited partners. And so our main general partners, Mark, Bill, and Bob, this is what they're doing so much of their time right now.
And just like any startup has and goes out and raises from investors, VCs and general partners do the same exact thing with LPs as well. And LPs are generally investing a small number of their assets into this asset class, venture capital, just because it's high potential return, but very risky. And so theoretically, if you're a good venture capital firm, you should be beating the returns on public equities like S&P 500 or Dow in order to really earn your stripes as a VC.
Right. And so it's really important to understand then that when venture capital firms are considering making their investments, they're considering making those investments because of the returns that they potentially promised to these limited partners, saying, you want to invest in our investment thesis because we think we can make you a better return than perhaps other possibilities for you to invest your money in. And so there's obviously a huge concentration on the money for venture capital firms because that is how they raise their money in the first place. And so everyone is judged on their track record. So as we're going out now and raising our third fund, everyone is looking at our track record. Okay, here's who you invested in, here's how those investments have performed. So when we go out and raise these venture funds, the limited partners commit to investing commit to providing a certain amount of capital to the funds. Now, they don't provide that money to us right away. Let's say, you know, for our $100 million fund, someone says, I'm going to provide you $10 million. Well, we don't get that money right out the door. Instead, they've committed to providing it, and we make capital calls as we need the funds. As we know we're going to be making certain investments, we call the capital from the limited partners. We also need to get paid ourselves. So there's always a management fee associated with the venture capital fund. And so typical management fees for venture capital funds are between 2 and 2.5% of the total fund per year. So if you have a $100 million fund and you have a 2% management fee, you're receiving $2 million per year then from your limited partners. And so that's what we kind of live off of for our salaries, for rent, for travel, et cetera.
Right, and funds that get very large, they start removing the management fees because then the general partners can get rich just off the management fees. And so for funds that are usually around $1 billion, they do what's called a budget-based fee, where limited partners will set a budget for what the salaries are and the travel expenses, et cetera. But generally, for funds less than $300, $400 million, you go by management fee, and it's in some ways incentive aligning. With a smaller fund, you have less management fees, and so the incentives are aligned for the GPs to maximize profits in the fund and really get their economics from carried interest, which Kirsten will talk about in a second.
Yeah. So we're still a smaller fund. We're still a management fee-based fund. Obviously, the main reason that the limited partners are investing is because they're hoping that you'll perform very well, and therefore they'll actually receive a good profit off of their investment. And so that comes to the next point on this slide, which is the split of the profit. As we receive money in from the investments that we make, and therefore, and then we've exited from, be it through an acquisition or an IPO or some other type of exit events, we first pay back the limited partners. Now, there's different structures with different funds actually about how this works, but our fund in particular, how we do it is we pay all of our limited partners back first. Once they are fully paid back all the capital that they've already put into the fund, there's usually some sort of interest payment that also then goes to the limited partners. And after that is paid, you're at the point of profit. And profits from venture capital funds are typically split 80-20. 80% to the investors, the limited partners, and 20% to the general partners. And this is the real reason that the venture capitalists are doing what they do, is because of this potential 20% that they can be making in the long run from this fund. They're hoping that they will have a very successful fund. The limited partners will be happy, and therefore they'll also do well. We have a little bit of a caveat with our particular firm. That 20% that goes to general partners, we've actually allotted 25% of that, or 5 points of it, that actually goes to our universities that we've partnered with. So that's one of the incentives also for the universities to work with us, is they can actually receive a part of our profit as well. Anything else you want to say on that?
I think it's good.
Okay. Thank you. And if anyone can't hear me because of my cold, please just raise your hand and let me know. Funds typically have a 10-year life cycle. So one of the things you always need to know about a venture fund is where is it at in its life cycle? How long do they have to actually make an exit out of the particular opportunity that they're going to invest in? So it's usually 10 years. That's a typical fund life cycle. They may add on additional 1 or 2 years based on what's happening with the investments. But understand that they need to have an exit event happen sometime within that fund life. And so when you're pitching to a venture capital firm, you need to understand when your potential exits are and how that actually works for the fund.
And this is important for you as a startup because sometimes if funds are not doing well, their LPs will force them to exit positions after that 10-year period. And so there have been venture funds, for example, like CMEA Capital, which started shutting down, where they had a portfolio of actually quite successful companies where their LPs forced them to sell their positions either through a sale of the company or their shares in secondary shares. And so as a founder, what can happen to you is you get forced into selling your company early, and you don't get all the economics that you possibly could out of that company. or you get a very unfamiliar, odd investor into the mix that buys the shares from the original investor. And so you have someone on your cap table that you don't really know. And so it can actually have some pretty dire impacts on your company if you take dollars from a fund that is very late and possibly not doing that well.
Yeah. So, as a potential startup company that's going to take venture capital money, not only are they going to be doing diligence on you, you need to be doing diligence on them, understanding how their fund works and where they're at and their strategy. Typically, funds are going to invest in that 10 to 12-year period I told you about. Funds are going to invest, make initial investments in portfolio companies in the first 4 years of that fund. The remaining 6 to 8 years, they'll be doing follow-on investments, et cetera, for the portfolio that they already have, but they won't be making new investments out of that particular fund. However, they may already be then starting to fundraise for their follow-on fund, which is what we're doing right now. When a fund invests in a startup company, they're not investing just for that particular investment point. They're usually reserving $2 to $3 per $1 actually invested for follow-on investments. So they're committing potential capital for the future that actually may be associated with that particular investment. So whenever we're looking at our cash flows, we're looking at what we've already invested, what we've committed to invest, and what we think we may be investing as reserves in the future for those particular companies as well. Anything else you want to mention that?
No.
Okay. And we've already talked about the subsequent funds, and we need to get going a little bit faster. One of the things that we do always want to mention to people is that very few startups actually need venture capital. And very few startups actually get venture capital. Now, those that are science-heavy and need a lot of resources to actually take a product to market, they're more likely to need venture capital or potentially financing from banks or other folks, because there are a large amount of resources that go into that. But it is a very difficult process, and there are very few opportunities that actually make it to the point of getting that venture capital funding. So this is actually kind of our deal flow annualized. We typically make about 12 to 15 investments per year. We're looking at a couple of thousand opportunities per year. And so it really is very few opportunities that we actually make the investments in. But we do a lot of work to actually get to that point of making the decisions on those few investments that we make. So how we actually make those decisions to get to the point of investment is part of our diligence process. And so just throwing it out to all of you, what do you think are the major things that venture capitalists are looking at when they're looking at the startup opportunity? The team? Yep. Anything else? Sorry, what? The product, not just the concept? Absolutely. And the market size? Sure. Yes? Timing, absolutely. Yeah. An exit strategy. Yeah, you guys basically covered my next slide. So I think team, absolutely. Team is the number one. We're a management-focused investment firm, and we're heavily looking at the team that we're investing in. It may not even be the right team for the technology in 2 years, but is it the right team right now? Is there anything particular you want to say about team?
Yeah, I mean, I would say that the team aspect of it is probably most important really early, just because with very early stage companies, there's going to be a lot of adaptations and pivots, and so you're really backing the jockey. You're backing someone that can really change the business model if you need to and adapt it. Later on, once you have product market fit and you're selling product and it's more operational, it's a little bit of a different bet. You're probably betting on a CEO that knows how to scale and build a bigger team and much more focused on organization. And so the team does flex a little bit, but I would say that is pretty important and essential at every single stage in a company.
Yeah. And then I would say on the tech side, market opportunity is the next highest.
Yeah, I mean, just the returns expectations for VC firms are kind of 10x or greater on your best deals, and you generally have only a few of those in every fund. And so every single opportunity has to have the ability to get to a 10x deal or not. And getting 10x, it kind of depends on how much the company raises in dollars, but you also want to be able to put a lot of money in and get that 10x. And so the number of opportunities that leaves is actually limited, because you really need a startup that's tackling a multi-billion-dollar industry to be able to generate that kind of return.
And the one other area, the couple other areas that I'll mention on here is definitely what the competition is. What already exists? What do we actually see coming down the pipeline in the same areas? I mean, there are already a lot of opportunities that are being developed in this particular area. What is the intellectual property protection around this? What kind of fence are you able to build? Although I would say that really depends on the technology, how important that is. Having come from a tech transfer background myself, I think I was surprised at sometimes how little the IP actually matters compared to the opportunity in the team itself.
Yeah.
So, in the past, there was always kind of a thought with a venture capital fund, you were going to have kind of a third of your portfolio fail, a third of your portfolio do okay, and then a third of your portfolio do well. But recent numbers are actually showing things to be quite different than that. That really about up to 3/4 almost of the opportunities people are investing in just fail. There's really no return or very minimal return to the fund at all. Certainly not what was invested in the opportunity itself. And then about 11% of those go public. That may be a good return or not. Sometimes it's all right, but sometimes they still don't even bring back the capital, as you know, that was invested in them. And then about 25% of them are having M&A events, which has been doing well for us.
Yeah, and so if you think about it in terms of funds, some of the very large funds out there, so like NEA is a $2 billion fund, the amount of value they need to create in terms of companies is astronomical, something like $60 billion to get a 2.5x fund. And so 25% of their companies have to generate $60 billion in value for them to generate an okay return on their fund, which is kind of crazy. And so I would say the stakes in venture are getting bigger and bigger with bigger funds. But it's still pretty essential to back companies that you think can really generate that massive return, to be able to return all the losses in your fund, because you're going to have a lot.
Yeah. Yeah.
Looking at your chart, it appears that M&A is about 15%, but you're saying the number is 25?
It's a 25
yeah.
for M&A. Oh, yeah, we have an error.
The chart, it is off, yeah.
The pie is off?
The pie is off, yeah.
Good eye.
Right, and it's because of the 65% number, so it's just, yeah. So the question was about the percentages and why they don't exactly match, and it's because there's a variance in that, yeah. Okay, so let's talk really quickly about pitching new ventures, and then we'll go on to the founders' equity part of the presentation. It is very true that you only can make one first impression, and it is very important to make a good first impression. And so you need to know who it is that's making that first impression of your technology, of your company, to the venture capital firm. I think we're somewhat unusual with venture capital firms just because with startup companies, we look at them over and over and over again because that's part of what our job is and how our model works. But with other venture capital firms, you really may only have one shot on that. So it is really good to know, first of all, who it is you're pitching to, whether they really would have an interest in this particular area. So get to know who it is at the venture capital firm you actually should be approaching about the particular technology. If it's a robotics play, is this person who's done investments in robotics? What have they done in this particular area? Are they going to be the most receptive? Typically, you're going to want to approach an associate first, not the managing partner.
And there's like an age-old saying in venture that if you ask for money, you'll get advice. If you ask for advice, you'll get money. And I think that is actually quite true. If you approach people, you treat it very much like a sales process. You get people a little bit interested, keep feeding them, and then you get them to buy into your vision. And so, I think that those rules apply very well to VCs, though, I think that reaching out to quite a few, and most VCs are pretty accessible these days. And so I think running that sales process, a lot of times you just kind of have to do that if you're raising capital.
Yeah. Well, and actually that goes to some of the points on the next slide. So one of the points that, and we actually need to change that on the slide, it used to be the saying, don't cold call, somehow find an intro, et cetera. But these days, especially I think in the tech world, you can absolutely cold call. You can reach out to someone and hey, maybe they'll return your call, maybe they won't. But reach out somehow. Go to conferences, go to some places where those venture folks will be, and just meet them. They're mostly very approachable, John.
Yeah. Yeah. There's some actually pretty interesting stories about how some entrepreneurs have used Facebook ad targeting to be able to target one person and get them to click on an ad, and then it shows up with their pitch. So you can get pretty creative.
Yeah. With your pitch deck, some of the things you really want to think about is preempting any killer questions. If you know that there's an elephant in the room, you got to address it. You're going to get the question anyways. Be thoughtful about it. People should know ahead of time that you have thought about that particular big question. When you don't know something, you need to say you don't know it. Don't BS. BSing is one of the worst things you can do when you're pitching, because the VCs do a lot of diligence on the company, and they will figure out if something doesn't hold true. It's something that, you're the one who does part of the diligence process all the time, and you really don't want to learn about something through other channels that you should have known up front, because that's a real way to kill a deal.
Yeah, we had a few CEOs pitch that had criminal backgrounds that we found out later on.
Yeah.
Then you immediately pull the term sheet on those. Those are hard to get through the investment committee.
Okay. And if you don't know the answers to something, you should say so, but also say how you're going to find out the answer to something. That's a really critical thing, is learning to say, I don't know that, but I can get that back to you, and here's when I can do it by. And then, because they're writing this down, and they will follow up on that in particular. Here's our slide on what we think are the elements of a great pitch deck. I'm not sure every VC would agree with this, but this is kind of what we like to see in our pitch decks. Obviously, an introduction about the opportunity itself. One of the first things that we want to see is who's the leadership associated with the opportunity, because again, we're investing in the team. We want to know who it is that's actually a part of this. We want to know what they've done before, how this team has worked together, what failures they've had, what successes. And talking about the failures actually is really good. We want to understand, okay, you've had these failures. What did you learn from those particular failures?
Yeah. And I would say to distill it, the thing that we're looking for is what is your background or your unique insight that gives you as an entrepreneur an edge over everybody else in this industry. And that can be a lot of different things. If it's a very new industry, you don't necessarily have to be a background. You can just be a first mover. Or you can come with it with a very expansive experience roster and tackle problem. But ultimately, you're looking for why is this person unique in being able to tackle this problem.
Yeah. Then we're going to go into the market opportunity. We want a couple of slides on that. We do want to know then, following that, what the actual technology is and the data behind that. Why is this solution so much better than everyone else's? And that leads into the competition. Tell us who your competition is. When we're doing our own diligence and we find out other competition we think should be there and it wasn't there, we're going to question how much really do you really understand the space itself. And then we want to know what the plan is, how you're going to use the money. Really having kind of a Gantt chart out showing exactly what's going to happen when and what inflection point you're getting to actually raise the next money. That's really important in the deck. It's going to be a 1-hour pitch session if you get to this point. This is the full pitch deck. This will often be with the full team, at least at our venture capital firm. You are going to have pre-conversations with other members of our team, and they're going to dig into each one of these areas quite a bit. So I think that is, one more slide before we get to the founder's equity itself. And we already covered this, but this is just some data on the most important factors for investments to get invested and to be successful, but also the reason they fail the most. And this is from a paper that actually was a survey of hundreds of VCs done by a few different well-known academic institutions, asking them about why the particular startups either did well or they failed. And it was pretty much team across the board for all types of technologies. And then coming actually in a close first for healthcare was the product itself. There's just on the life sciences side in particular, the product itself is often the reasons the company either succeed or they fail. Just everything happens when you're actually doing research and development. So, all right, on to founding team equity.
So, we created this talk around how to build cap tables because we saw in a lot of early stage companies that cap tables were being incorrectly built a lot of times. And it leads to a lot of irreversible issues down the road. And we thought it'd be pretty important to kind of explain our thinking behind cap tables and why it's really important to be strategic early on about it. So, I'm curious, who here has ever allocated an initial founding cap table for a startup? So we have some experienced people in the room. One of the problems is that when you first start allocating the cap table, everybody kind of thinks like this. They start thinking about all the billions of dollars of net worth they're going to generate from their 50% ownership stake of the company. But the reality is that things often go wrong in venture, and that you actually need a lot of people to help build your startup with you. And even then, things can go wrong. And so these are all the companies where things went horrifically wrong, even after raising a ton of capital. And so, I'm curious as to what people think are maybe some of the issues with having a poorly allocated cap table. Anybody have any ideas? No? Don't be shy. No? Flexibility.
Who's going to contribute parts of their share toward the new resource that's needed?
Yeah. One of the main problems is that sometimes you may have people on your cap table that are no longer contributing to the success of your company. And so we often call them parasitic founders. Once you grant equity, you can't really take it back, especially if it's issued. And so you have people that may own large ownership stakes in the company, but no longer work with the company or are affiliated with the company. And we see this all the time, particularly with co-founder disputes. One person leaves. It's really hard to get those shares back unless you do a recap. And what that can lead to is you have a lack of equity to compensate any new hires or existing hires. People that you're hiring are usually very well qualified, very talented, but you need to compensate them appropriately. They're usually people that are getting poached by very large tech companies or big corporations that can pay a lot more money than you can. And so you have to make up with it with equity. And if you don't have enough, it's going to be a big problem. And so you're going to have unincentivized employees that are going to leave. And we see this all the time at startups where talented engineers or talented people at the company just leave because they aren't getting enough economics from the startup. And so, the final option to fix this is recapping your company. If you have investors, this is a nightmare process. We went through one of these recently, took 6 months and 100% of our focus to get it done. An investor will only do it if the company is really worth it. And
do you want to explain really quickly what recapping means?
Yeah, so recapping basically means issuing a lot of new shares in the company so that everybody else gets diluted down to basically nothing, and you can reissue shares to everybody else in, I guess, a more appropriate manner for the state of the company. And so, it's a way to basically effectively remove people from the cap table without actually removing them. But the problem with it is you have to get approvals from all the people that are on the cap table. And so you're basically telling people, get rid of all your shares and sign off on it. And it's really hard to get people to agree to that. Sometimes you have to make kind of individual offers to those people, and it can get very expensive and very complicated, and the likelihood of success in it is extremely low. And so it's just a very challenging thing to go through, and it's an unlikely scenario. And so people should always assume that if you have a cap table that's messed up, it's likely going to stay that way in a lot of ways.
So that's why it's so important to get your cap table right early on and be able to have these incentives, for not only employees you have now, but for the employees that you're going to be bringing in.
Right. Yeah. And the same thing applies to investors as well.
Yeah, it's true.
You can have very bad investors that are no longer contributing to your company. They can be parasitic. They'll take a lot of equity in your company that you could have had for compensation. And sometimes you have obstructive behavior from investors. We actually see this a lot on the strategic investor side. Sometimes strategic investors may have a different interest than the financial success of a startup, and they may start pushing or pulling their weight to make you less successful so they can buy you on the cheap. And we have seen that many times. And so be careful with who you bring into your cap table and make sure their goals are aligned with yours, because it can be very destructive. And so this is just a scenario of a company and the equity allocation throughout rounds of financing. And so on the bottom, it's the founding cap table to Series D. On the top, it's just the relative ownership that each class has. The blue is the lead founder or CEO of the company, the person that's really going to take the company throughout the lifetime of the company. The other 40%, the pinkish red color, is your employees and your other co-founders, and then 20% is just your option pool. And so the 20% gets refreshed almost every round of financing. But as you notice, the new bars that come in, the green, the purple, the teal, and the yellow, those are all investors, and they take a lot of equity on your cap table. And that's part of the thing with venture. You have to raise a lot of capital to take some of these things to market, and that's really the point here is that you should really only be taking capital if you need to, because venture is really one of the most expensive forms of capital you can take in terms of control, dilution. It's pretty expensive. And so the average successful tech startup raises about $41 million in capital, and they exit for around $240 million. That's a successful tech startup. And typically in those situations, the lead founder exits the company with 11% ownership. I mean, 11% of $240 million is quite a lot, but they did go through a lot of dilution to get there. And that's typically what you should expect as a founder if you have to raise a substantial amount of capital. And the reason for that is you have to hire people that are more talented than you can afford to pay them. So you have to pay them with equity. Any questions on this? Great. And so this is kind of a general template cap table that we see a lot. We see initial CEOs and lead founders taking about 40% of the company. And to clarify, these are people that can take the company throughout the lifetime of the company. And so in some ways, it takes some introspection as an entrepreneur to think, am I really the CEO that can take this throughout? Am I kind of an interim CEO initially that puts the company together? The thing that you should be considerate about is you should have enough space on your cap table if you think you're going to need someone else to lead the company later on. And that's a hard thing to admit to yourself, to be so introspective to say, I may not be the person to take this forward all the way, and so I'm going to set aside this much on the cap table to hire someone down the road. But it can actually ease up a lot of things down the road. And frankly, what you can do is allocate a small amount for yourself as, say, interim CEO, and if you do succeed, you have it in writing that you can take the rest of the amount that you've allocated for a new CEO. That's probably the best way to structure it. And then,
Oops, we had a question.
Go ahead.
Are there typical timeframes associated with each of the series?
Yeah, so this would be at founding. And then at time frame, it's generally about 18 to 24 months between each funding round. Yeah. And the average step up in valuation is about 1.5x per round of financing. And so your other co-founders' employees will take about 40% of the initial cap. These numbers are pretty fluid. They can certainly move in a lot of ways. And then you generally want to allocate about 20% for your option pool. This is for new hires that you're going to issue options for later on as you bring in capital and as you need to hire more team members. And so one thing that we recommend all of our startups to do is always to have a chart that defines by position what the equity grant should be by position. And so this is generally an example of a founding chart of what equity compensation should be by position. So as I mentioned, founding CEO, you generally want to allocate about 30 to 60% at founding. With university startups, we often come across startups that have founding scientists associated with the companies. And we've generally seen two types of founding scientists. One is an active founding scientist. This is someone that may leave the university for a couple years, but is full-time at the company for that couple years on sabbatical or on leave, and then goes back to the university afterwards. And we've generally seen in our startups, those people taking about 20 to 25% initially. Sometimes they take more, sometimes they take less, but it's certainly pretty varied. One of the challenges with an active founding scientist being a CEO is that eventually they do go back to the university, and so to not have that equity to hire someone else after they go back to the university is challenging to pull off later on. And then past founding scientists, these are generally advisors to the company or people that may have developed the initial technology but are passively involved in the company. We've seen them take anywhere from 1% to 5% of the initial cap table. And then I put CEO there for if you were to hire somebody in later on, we generally see about 10 to 20% kind of pre-financing is typically going to one of those people. And then the numbers for directors, lead engineers, all those kind of vary. It depends on what's right for your company, but these are the general ranges that we see initially.
One thing before you move on, and I realized that we didn't have the updated version of this slide, is actually the university, obviously, if this is a university startup, there's also a portion of equity that is going to the university as well, and that is something that we should add to this slide, which is usually in the lower percentage range as well.
Right, and so a lot of people ask us what is the value of scientific founders, especially if they're leaving the company in a couple years and going back to the university. And we've actually seen quite a lot of benefit to have and to continue granting options to scientific founders. And oftentimes when they do go back, it's very tough to stay up to date in a startup because things are just moving very quickly. And so oftentimes the day-to-day roles do diminish pretty frequently. But the main things that are really valuable in having some of these scientific founders is the continued research contributions to the company. We've seen many companies succeed because of that pipeline of innovation, and that alone is a good reason to continue issuing grants to academic founders in a company. The pipeline for hiring students is a great source for new talent. High-level research connections at bigger companies has actually led to quite a lot of business development deals at a lot of our portfolio companies. And in some cases, even acquisitions have been driven by scientific founders that had those high-level connections. Additionally, having scientific founders raises the profile of the company and gives the company kind of a cutting-edge feel to it. So any questions on that? No? And so one of the questions is, what exactly are you competing with as a startup versus larger tech companies? And so we have some data about what typical engineers are paid at some of the FANG companies. And so up there is a Google search that auto-completes our baby's dishwasher safe. And that pays for close to $400,000 or $500,000 salaries for relatively senior level engineers at Google, Amazon, Microsoft. So the salaries that you're competing with, there's no way a startup could pay $500,000 for a senior engineer. It's just impossible.
That's not even what you're paying your CEO.
Right, yeah. I mean, CEOs for a well-funded Series B startup make about $250,000. And so there's no way that you could pay any of your engineers even close to that. You're generally paying kind of $100,000 to $150,000 per engineer. And so you have to make up for that difference with equity. And you have to be ready to dilute yourself to be able to hire the right people. And it's difficult to convince those people. In addition to this, you actually turn over quite a lot in a startup. There are actually kind of three distinct phases in most startups where you need three different teams. And the first phase is product development. This is kind of a highly technical, kind of almost research-driven team that's building a product out of nothing. This is a very different team than a product market fit team that's starting to build out some of the processes, testing the market, figuring out what products work in the market. And then this is very different than a team that scales, which is largely building operations, things like QA, things like shipping the product, things like having a very nailed down sales process. All those things require very different teams. And so not only do you have to make room to hire new people, you have to make room to hire people that have left. And oftentimes at startups, you generally see full turnover of your company every 3 or 4 years. And so you should think about that as you're initially allocating options, because it is a pretty large chunk of, it's going to be a pretty large chunk of your cap table moving forward. So, the basic message is if, yes, you will be diluted, and but without your team, you'll get nothing. And so, one of the things that we like to tell our portfolio companies is to have a pretty detailed plan of when they issue options. And there are really 4 different scenarios in which we recommend our portfolio companies issuing options to their employees. One is new hires. So you go to that chart that you make with the position and the number of options they get, and you issue that to every new hire. So pretty straightforward. Another is promotions. Generally, you want to make sure that the people at your company are feeling like they're moving forward. And so anytime someone gets a promotion, you issue them the options they would have gotten if they had been hired today. And then outstanding performance options. A lot of companies don't do this, but we like to push our companies to do this just because it is aligning to have employees that are incentivized with additional performance-based options. And so we generally recommend for about 10 to 20% of your top performing employees, you issue them about 50% of the shares you would have received if you were hired today. It's a lot, and it can make up a pretty substantial portion of your option budget, but we think it's pretty important. And then evergreen, most of the options that you issue have a 4-year vesting schedule. So basically, every year that you vest, or every year that you're there, a quarter of your shares vest. And this is relevant because eventually you start getting close to that 4-year cliff, at which point you will have no more options to issue the person and keep them incentivized to staying there. And so, we recommend that at the 2.5-year anniversary of an employee being at the company, you issue them a quarter of what they would receive if they were hired today, every single year from that period on. And so it just kind of pushes out that cliff another year, every single year. And so, as you can see, your option budget quickly gets used up on a lot of different things. And that's why it's important to plan. Because we actually see this quite a lot where new CEOs don't plan well enough in terms of the number of options they need between financing rounds. And they can run into a situation where they have to push off hires a quarter or two, which can delay your product launch, can delay your sales process, and it can lead to a lot of things that slow down the progress of your company. And so having a pretty solid option plan is pretty important.
And are the CEOs typically looking to their board for advice on the option plan? Are they looking to their lawyers on that advice?
Yeah, I would say early on, frankly, CEOs are kind of on their own to figure this out. Lawyers do have pretty good advice, specifically if you go to lawyers that are very familiar with startups, like Fenwick or Wilson Sonsini, those kinds of firms. The board, if you pick the right investors, the board should have great advice on this. They won't have specifically what's called a comp committee till later on, where it's an independent committee on the board that sets what the option grants should look like. But early on, you can ask them informally to serve in a comp committee function. And that's one of the things you should be looking for as you're choosing your investors that have experience with this, because this is one of the things that gets messed up the most in startups. And so having someone that's experienced and knowing what to do in this situation is pretty helpful. And so here's some different options for options. Restricted stock units are actually just stock grants. These are actual shares that you're issuing to employees. This is only relevant at the very founding of a company, and that's because they actually have a tax consequence to them. And so when you're first starting a company, the company is worth nothing, and so you can issue these RSUs without any tax consequence to the people that you're issuing it to. And so when you're first starting the company, this is probably generally what you're going to be issuing to your founding employees and founders. With this, you also have a vesting period. It's just different in that it's not an option, it's actual shares. And so it's just nice to know that you're an actual owner of those shares. Most cases, later on in the company, you're issuing what's called an incentive stock option, ISOs. These are basically an agreement to purchase the stock later on at a set price, and that's called basically a hit price. And so this is, at some point in the future, you can buy these options. They do it that way so that you don't have an initial tax consequence as well, so that as a startup employee, you're not paying tax up front when you're receiving these options. But they do require pretty frequent valuations of the company, external valuations of the companies called 409As. And so this is what a company will do every time they have a financing event. They'll get an outside firm to value the company so they can set the option strike price. And then the last one is a non-qualified stock option. These are essentially for people that are not full-time employees of the companies. This is to advisors, this is to people that may be on your board, and these do have an immediate tax consequence. And so you can't give these, or you can't give ISOs to people that are not employees of the company, and so this is why you have a non-qualified stock option. And one of my last points is that there's a lot of different types of companies out there that have different capital needs, and oftentimes a lot of people apply the milestones that have come from the software investing environment and apply it to their own company, but frankly, they don't always make sense. So for example, we see a lot of hardware companies now, and normally in software, you want traction at your Series A to be able to get a decent valuation. For most hardware companies, you don't release your product till after your Series B, and so you're not going to have any traction. And the important thing to realize with that is that for a founder, they should keep that in mind, because they should be setting their expectations on valuation similarly to what types of traction or validation they have. So hardware founders may take a bit more dilution early on to raise capital, but later on, the dilution, actually the price increases are much higher, just because in some cases it's harder to copy hardware. So it's just a consideration of what your industry is, what your capital needs, what types of milestones you have, and whether your valuation expectations are in line with that. Because the problem with having too high valuation expectations or raising at too high of a price is that your expectations or the milestones that you need to achieve by the next round are only higher. And so there's a possible chance that you would get recapped at that point by an investor, in which case the value of your shares would go down pretty significantly. And sometimes you would lose a lot more shares, because investors often put in what's called anti-dilution protection into their investment terms, which give them very positive economics in the case that a company has to raise a round at a lower price from the previous round. And that can be very destructive to kind of economics for a founder. And the moral of the story is not all startups are created equal, and so people should just consider what type of business they're in and raise appropriately and allocate equity appropriately for that industry. Great. And that's it.
Yeah, questions that you have? Yes.
Yeah.
Thanks. Oh, and for the questions, they asked us to have you come up to the mics, I guess, because I think they're recording, so they want to be able to hear the questions. So.
Good afternoon.
Thank
you for the topic today. Just a quick clarification. When you said that there are anti-dilution measures for the investors, is one of those like a liquidation preference? Can you give some examples of those anti-dilution measures?
Yeah, so an anti-dilution measure is basically if an investor has bought in at $3 a share and the next round of financing is $2 a share, they can have some protection so that they get issued their shares at, say, $2 or a price in between, in which case they would only be the ones getting issued shares, and so it would be dilutive for everybody else that doesn't get issued shares. And so it's basically a way to correct the price of your share to the new price of your share. And so there's something called full ratchet, which is all your shares convert to the new price, in which case it's highly dilutive for the people that don't have anti-dilution protection. But in most cases, it's some average of the two prices. But almost every investor usually has those in a financing round. No.
Quick follow-up to that. So how would you describe the category of procedures as liquidity preferences? 3x liquidity preference, 4x liquidity preference?
Liquidation preferences, in some ways it's kind of like an anti-dilution protection as well. All it's saying is an investor has to get a guaranteed return before anybody else gets any money. So for example, if someone invests $10 million into a company at, say, a $90 million valuation, so that's a $100 million post-valuation, they have to say, this company has to sell for an amount where I'd have to get above $10 million before anybody else gets their money. And so the thing that protects against is actually, say an investor takes money from or say an entrepreneur takes money from an investor, then liquidates the company the day after, then gets a chunk of that money that the investor put in. That's largely what liquidation preferences are built to protect against. And I'd say during the tech bubble, a lot of investors started putting 2, 3x, 4x liquidation preferences, where they'd have to see 2x or 3x or 4x the dollars they invested before anybody else got money. That is no longer really a norm. You see that sometimes in late-stage investments in companies. For example, I think Cloudera had a 2x liquidation preference from the last investors before they went public. And so you see that at very later stage investors, but not that common at the early stage.
But basically, I mean, the main thing for those who aren't, the investors are going to get their money first. and those of you as employees get your money after they're paid back.
That was all very informative. Thank you. There was an early chart that showed you look at something like 2,000 opportunities a year to get to 12 to 15 or so.
Right.
Two-part question. How do you generally find out about those 2,000 opportunities? And then about how long do you spend looking at each one of them on average?
Yeah. I would say that we spend about 50 to 60% of our time sourcing deals, which is generating those 2,000 leads. And they can come from a variety of different places. We've built a lot of technology to automatically track and find some of those opportunities. There's also, like, traditionally, other investors would talk to other investors to get deals and share investing in a company. That's kind of dying as funds have gotten bigger and single investors are taking rounds. Conferences is another way. But oftentimes, if you build a good enough brand, people reach out to you. And so for a lot of firms, they actually don't do any sourcing, and they only take inbounds. And then the amount of time you spend diligencing, some of it, I would say that the majority of those opportunities you're probably just going to reject initially, just to not waste anybody's time. And I would guess that's probably 60 to 70% of them. And then with a number of those, you'll take 30-minute call or an hour call, and then move from there, and it just kind of funnels down from there.
So in going to kind of how also our deal sourcing is, we do have this, and this is one of the unique parts of our model, is that we partner with universities to learn about their particular deals. That's a very different model than obviously most of the venture capital industry. So we talk with the tech transfer offices every day at the universities to learn about what's happening. And then we also get to know the other parts of the kind of startup ecosystem at each of the universities that we work with.
Right. I don't know who was first. Maybe.
So just a two-part question. Could you each maybe talk about your favorite investment experience in your career, and then maybe your least favorite in your career? And then the second part is, what do you see in the ICO landscape, and how's that going to change things moving forward to bring more people into this fold?
Yeah. I would say that my favorite investment experience has been a company called Elementary Robotics, and I think in that situation it was a scenario in which our firm could uniquely help the entrepreneur out a lot, just because we had a lot of experience specifically in that domain, and we could spend a lot of time. And so there we rolled up our sleeves more so than we did at other types of opportunities. And I think for VCs, the grass is always greener on the other side. I think a lot of VCs like to play entrepreneur, and in that case, you kind of do. But it's nice knowing that you can really kind of benefit an entrepreneur in that case. My least favorite example is a company where there was a founder that was adamant in raising a seed round. And before he raised a seed round, he was paying himself maybe $20,000. He didn't have a car. He was basically walking in the office. He had bootstrapped his company and hired 5 employees with basically nothing, and was really suffering. And then right before the seed round, he got an acquisition offer for $30 million. And so he owned 80% of the company. He would have walked away and would have changed his life completely. And so we tried to convince him, you should not raise a seed round, just take the money and go. And we talked to him a number of times to do that. He did not do that. And he raised a seed round from us. Ultimately, the company didn't do very well, and he walked away with basically nothing. And so that is a really shitty situation. And so you get those every now and then, and you try to inform the entrepreneur as much as possible. But he made up his mind that he really thought it was a bigger opportunity. And oftentimes things just don't go that way. And then ICOs. I think ICOs are a really interesting opportunity for disrupting capital, how capital is allocated. I think it makes sense largely for companies that are building protocols on the blockchain. And so this is where it really does make sense to have something distributed or distributed application, and then to have currency. Because for those companies that raise ICOs, they're only accreting value by the increase in value of their coins. And so if your coin doesn't benefit from, say, Metcalfe's law, which is the increase in value associated with network effect, it doesn't really make sense to do an ICO. And so if your company is protocol-oriented, makes sense to be decentralized, it's a no-brainer. Do I think it's going to destroy venture capital? I think it's a non-relevant question, because I think the opportunities that require an ICO are actually different than a lot of the opportunities that require venture capital. Yeah.
And I'm not going to comment because I'm not on the investment team, so.
Yeah. Maybe over there?
Yeah, thanks for your insights today. I was wondering if you had any more insights around kind of at founding, how to sort of separate who's a founder, who's a co-founder, who's a key initial, a C-level CTO, or and if you have any insights about what is the best practice or what leads to most success as far as single founder, co-founder, and if it's different in the academic environment, coming out of the academic environment or away from academics.
Yeah, in my personal perspective, I think titles are really cheap to hand out, and they have a pretty strong impact on self-confidence, and so why not just hand out big titles? I think the more important thing is making sure that people's roles are well-defined, and then your equity compensation is based off that. And so in some ways, it's a really tough conversation to have with somebody saying, what can you contribute to this? This is how much equity you're worth. In a lot of ways, it's a little too objectivist and not very humane, but it is a conversation that's really important to have, because I think what it results to is an equally allocated cap table, which is one of the worst situations you can get in. Later on, it's impossible to fix this. I'm actually going through a situation where an experienced entrepreneur had an equally allocated cap table, and I'm on the board of that company, and it's a nightmare to figure those out. And so it's tough to have those conversations. Experienced entrepreneurs get it wrong all the time as well, but being upfront about it and having that hard conversation early on is better.
So, I'm sorry, so in this, it's a nightmare in the sense that voting rights and too much is misallocated?
Well, in this specific situation, the CEO wanted the shares of his co-founder to go directly to him. And as you can imagine, that causes a little bit of tension. And so, in that case, it was talking through both groups and making sure that there was an equal or a fair resolution to it. And this was in the middle of a financing. So, the company's raising a $20 million financing, and this is happening. It causes a lot of unneeded stress for the company.
So, and again, I'm not on the investor side, but I've worked a lot with startups, and to me, when you've got this group of people who potentially want to found this company, there are certain attributes that go along with each roles of founding a company, and there is a certain gravitation each one of those people is going to have towards those roles and the skill sets that they already have. And to me, the way that it works best is people each recognize in each other how they fill each one of those roles. And if they can't recognize that, the team is not going to work. But there's usually an identifiable person who should be the leader, and there's usually an identifiable person who would be the operations person, and an identifiable person who will be the CTO. And if they're having troubles figuring that out, then you're missing someone, or you have too much of one person, one type of person. So we have some other, if you follow with us, we have some other slides, et cetera, that we can talk about, those attributes associated with each of those roles.
Kristen, John, first of all, I would like to thank you for a very informative presentation.
I think you just have to
Come
speak
a little bit closer. Yeah.
Okay. So I would like to thank you for a very informative presentation. My name is Vishnath, and I have a question around tax liability. You covered in one of your slides, but what's the best option for employees not to get hit by taxes upfront especially knowing that this company, the exit will be 5 years away, and until you have successful exit, these stocks may be nothing, but you'll be paying taxes. So
Right.
what's the best strategy for them?
Yeah.
That's first question. Second part of this is, can employees, how they can ask for or negotiate anti-dilution clause in their options or stock grant?
So the tax liability question, if you structure it as a ISO, generally that tax liability is only going to be paid when you exit the company, and you can pay for the tax with the proceeds of the exit. And so you shouldn't have to pay any cash up front before you receive any capital. There are situations when a co-founder or someone leaves the company and they want to execute their options, and they generally have some time period in which to do so, in which they would have to pay some dollar amount to execute those options, but that's not necessarily a tax hit at that point. It's really only at exit do you have to pay those taxes. And then
Can I actually just comment on that one really quickly, just before you move on to the second one? So, because I used to work in university licensing, one of the things because it was the same problem, when you received equity, we actually, at Stanford, we would actually give the equity to the inventors right away. And so there was this, especially for grad students, what may be a burden, even a couple $1,000s, a burden of a tax liability if they're receiving these shares in the company. And so one of the things I would always do is when I was dealing with the upfront payments, I was always making sure it was enough money that it would cover their tax liability that potentially that they would have for getting these shares. And so to me, another way that companies can also structure this is to work out some kind of payment system too that helps them cover that tax liability. I don't know how many do that, but that also is another possibility.
Yeah.
Sorry, go ahead, second question.
Anti-dilution protection. You almost only see this in preferred shareholders in a company, and preferred shareholders are almost exclusively the investors that are investing. And so normally common shareholders like employees don't receive anti-dilution protection. In your term sheet, when you're negotiating to bring on an investor, you can negotiate so that they don't have anti-dilution protection, or they have very limited anti-dilution protection, which is essentially giving you some anti-dilution protection. And so, it's kind of adversarial, but, you can have it, I would say that most VC firms today are a bit more on the lenient side of anti-dilution, and so they'll go for what's called like a broad-based anti-dilution clause, which is a little bit lower than a full anti-dilution protection. So.
Thank you for the talk. It's really been informative. One of your early slides noted mergers and acquisitions, what was it, 11% or 15%, something like that. For the university-type technology, that's probably a very large, what you see really at the end, maybe not at the beginning. The question is, how do you sort and how do you handle that difference? Because it's got to be entirely different. You're going to sell your company to, I don't know, Xerox or General Electric or Johnson & Johnson, and all these options are a whole different game at this point. So how do you think about handling that problem, mergers and acquisitions, as opposed to IPOs?
So the question is, how do you decide whether to sell in a...
Well, you must smell something in the beginning when you realize that, where this is going. It's not 100%.
How do we invest in a company expecting it's an M&A versus an IPO?
You won't touch it.
I don't know if I quite understand the question.
I'm just, okay. When you look at the companies, at some point in time, either at the front end or toward the middle or end, you know this is going to become a merger or acquisition as opposed to an IPO. How does your thinking change and handling of these questions that have been raised? I mean, you must have different operational procedures internally to work that problem. And that's my question. What's the difference?
Got it. So,
I don't mean to put you on the spot.
No.
Yeah. So in terms of like what the exit outcome will be, oftentimes an investor has very little choice in that. And so, one of the frequent discussions that happens around an M&A is what you should structure the options for the people going into the company. And so basically you want to keep a lot of your value in an M&A is associated with your employees, and you basically want those employees to stay at the company after acquisition and not spread out. And so what we've been seeing more and more is that a lot of the acquisition value actually gets taken in the new options that are going to be issued by the acquiring company to the employees that are coming in. And so that can actually account for a fifth to a third of the value of the acquisition. And so that's a way actually that the employees get paid more in an exit than the investors. For an IPO, it's the way you make the decision is there are certain traction metrics that are normal for when you think you can IPO for types of companies. So for example, for a life science company, these days, generally after phase 2 approval, you can start filing for an IPO. For a software company, if you hit around $80 to $100 million in revenue, recurring revenue, you start thinking about an IPO. And at that case, it doesn't really make sense to do an M&A unless you get a very good offer. Does that answer your question? Yeah.
Hey guys, I don't want to take too much more of your time, but I was just curious on valuations. If you see any worries, I guess recently with global credit markets taking a little bit of a hiccup, and equities are sort of just sort of similarly sideways. Are you worried at all about, I guess, these stage companies having a similar move in valuations? Are you slowing down your investment process?
Yeah. Yeah, I mean, I think the macro environment is one to be concerned about, despite the strong jobs report yesterday.
Yeah.
There is, in my view, a lot of things that are worrisome. There is probably price inflation in the real estate market, probably price inflation in the equity market, and so I think we're probably at the end of a boom cycle, and that always impacts private valuations of companies. It's delayed by a year or so, but the main way that it will impact us is that some of our companies may have to raise at lower prices, and in which case they could be buying opportunities. If you think about the Google, Amazons of the world, they received most of their funding right after the tech bust in 2000, 2001. And then if you look at the most recent crop of the Ubers, Airbnbs, those all got founded and funded in the last financial crisis. And so actually, I think it turns out to be pretty good buying opportunities for the funds that have capital. It does get harder if you're a fund that is trying to raise capital. And so it gets harder to start a venture fund. For an entrepreneur, I think funding gets more selective, and so it's harder to raise new rounds of financing. I think you're starting to see that. There's been actually a collapse of early stage investing in the last year or so. Seed stage investments have dramatically declined as seed funds, which became really popular in 2012, just didn't return capital. And so you're starting to see something called a Series A crunch, which happened a few years ago, but come back in pretty hefty way. And so I think you're starting to see it already, where it's much more difficult to raise Series A round today than it was a year ago.
And I would say also, I mean, in general, I think this is something that we've been concerned about at least for a while now. I mean, there have been so many companies that we've considered overvalued that we've actually turned down a number of investment opportunities because we were concerned about this. So so there probably are some, maybe some corrections coming, but there are still so many opportunities out there. That we don't see slowed. We don't see our investment pace slowing down. So that was the other part of your question.
Great. Well, I think that's all the questions.
Yeah.
Thank you.
Thank you so much.